Good morning, everyone. Welcome to Phoenix Trading Strategies Trading Room this December 1st, 2014. Hope all of you had a happy Thanksgiving. It was a very long weekend. I guess we all needed it. So today we're going to be starting very soon. Just want to get a few things out of the way before we start looking at the charts. I always like to go over the disclaimer. It's usually important. Where is the disclaimer? Let's see. Let me see. One second. Well, very simple. The disclaimer is do not trade with money you cannot afford to lose. There is always risk when you are trading in the Forex or currency futures markets. And from that perspective, if you cannot afford to lose any money, don't trade. Just demo trade. You know, if you're demo trading, then basically you're just learning how the market is working, but you're not putting yourself at risk because you have no real money in the game. So being that said and done, let's continue. Welcome to Phoenix Trading Strategies. Today we're going to be going over how the indicators work, what the market did last night since the market opened again yesterday in the afternoon for me, which was yesterday morning for many of you that are in Europe. Very interesting afternoon, actually. I was watching how it was progressing, and one of the things that I discovered, you know, this is basically because our whole theory runs around volume and momentum. But unlike volume spread analysis that many others, you know, try to portray, we really go in this a little bit more further and in a much more profound manner. I'm going to show you an example, actually, of a trade that I took yesterday afternoon. And let me remove this crosshair and use a pointer instead, because I think it'll be much better. Now, we've been looking, I've drawn lines, and these lines basically signify these same momentum and volume identifier dots, which I call power dots. And the reason why is because every time that you see them come up, normally if they don't breach the level previous to it, then they'll usually go in the opposite direction, and that's exactly what happened here. This was pretty much a continuation move of Friday, or Wednesday, yes, of Friday actually, where basically this trade ended up coming down south. And it's amazing how the significance of this identifier, this indicator, gives you an edge of really what's happening. The reason I changed the color from white to gold is because I want you to realize and understand the importance of it and how it impacts not only your mind, but your trade and your confidence when taking that trade. For instance, yesterday at the open, you know, I had this right here from the previous day, which was Friday. And normally I'd seen that any time that this had appeared at the close of a day, it would be a continuation move. In actuality, it did. Now, I didn't take too much out of this trade. I only took, if that, maybe 20 pips. But this thing came crashing down even further, and it came down approximately about 45 pips. Now, why am I using this one as an example? And the reason I'm using this as an example is because there are many trades. This was, yeah, about 48 pip move, but I only took 20 pips out of it. The reason I'm using this as an example is because I want you to realize the importance of these dots. But I want you to realize the importance of these lines that I've drawn here. And the reason why I drew these lines is for the same reason that many of you don't seem to or are trying to pick this up is these lines are these same dots, but in different levels. So for instance, what I did, and I did this really just, for your benefit, I went to the 30-minute, and at the 30-minute, basically all I did was just scroll back. And as I scrolled back, as you can see, I found these levels, same levels, nothing different, and I started to identify them. And I would basically start to draw rays. So it would portray, because these same levels are usually hit by the banks consistently. And once these levels are broken, then these are the same levels that they'll bounce off of, like right here. This level, if you noticed, was way back here, literally 7 days, 8 days behind. It repeated itself, if you notice. So they came down, did not break this level, and then bounced all the way up. Now look at here. This same level appeared here. As they came down, they basically went up again. So they went up, retested, went back up. Now, as soon as it came down below this level, it came all the way right back down to the same level. And once it reached this level, it came even further down to other levels. So finally, we're at this level. But as you can see here, as soon as it broke again, it went right back up. So these levels are not really pivot points. I don't want you to confuse that, because many people do get confused saying, oh, well, those are pivots. No, those are price interest points that, or price levels that their algorithms are keying into. And if you're willing to do the homework, then this software will take you to a whole other level of trading. Why? Because you can see here, as they broke, they did go up, but then they came down. Once they came down, this dot was formed. But as soon as it was formed, it went right below it. Now, usually, there's a 10 pip difference from here to here. And if there's a 10 pip difference from here to here, and it's trading above a previous level, and this shows up, and you have these power dots show up, then guess what? You have a trade. Well, the same to be said here. If you have, for instance, these dots, the way they showed up right here, as you can see, right above the level, but price action was trading below these two levels. Continuation move. Now, in this case, it's a little different. Why? What's the difference between this and this? Price action was trading below, and so you can see that this trend stop right here, because this is really a trend stop, basically was trading below this identifier. And so it was a continuation move. In this case, this wasn't. Price action was not trading below this identifier. It was trading above the trend stop. And so it was basically going to break through, but that's okay, because this level will be repeated again. They will repeat this level. They will hit this level again. The fact that it appears on the 30 minute is very valuable, because it means that this section right here is going to be pretty much hit. And when they hit it, we'll do a dot. So I wanted to move that. Let's see if I can move it. Really? So the reason I circled this was because this section right here, as you can see, they had broken through this trend stop right here. As soon as they broke through it, then we started to see these forms, even though we started to see this formation. However, here, the difference here was this was a continuation move. They never broke through the trend stop here. So, and even though they did, price action at the open continued to come down. They never challenged this level. This level was too far from here. When this one hit, they challenged it immediately. So we knew that as soon as they traded above this level, it was going to go long, which it did. This was a good move during the European session to look for. And for those of you that have the ability to stay up during the night or are in Europe and are willing to trade this would have been a 105 pip move, which was very good. I'm happy just capturing 25, 30 pips out of a move during the Asian session. Believe me, I don't lose any sleep over it because I'm all the way here in California, where others will. So this, when you start to see this, the significance of these lines is that these levels are going to be hit again. And I told you, because of this level was previously historically hit, they're going to come right back at it. So eventually it will come here, but they never got all the way up here. So that's one example. I'll show you another example. This was the pound yen. And I also shorted this one, and I got out too early actually. I only made like 20 pips on this one as well, where this one ended up really moving significantly lower. The total move on this one was, let's see, from top to bottom, 43 pips. Not bad, you know, a very good move. And then this came out. Now, what is the difference between this and this? It had previously formed, and look how they hit this level. When this came out, it went long. When they came down to it, they didn't go below it. They came right at it, bounced right back up, then came right back down, but never challenged it on Friday. Went right back up to the trend stop, then came right back down. When they came right back down yesterday, which is today, of course, they came back, but they never tested it, and they hit the trend stop right at the money, right at the money. Not only here, I'll put a box around this because I want you guys to realize and understand that what you're seeing here is not only something that's repeating itself, but at the same time, it's giving you their pattern of trade, which is very important. This right here, this section right here, let me lower this, really. I hate when that happens. So this section right here that we're seeing lines up perfectly right here. And as you can see, they hit this all the time. They never went below it except here. Here they did, right at the money, but they never came down here. Now by not coming down here, they came basically and bounced right back up. This is a level of these power dots. This is a level of importance. And when you realize this move was really, really huge, because this move was approximately 98 pips, almost 100 pips. Now, of course, it's coming down. Now, it's not going to come down all the way. It's probably going to come down to this level of 179.03. It's at 179.18. So it still has another 15 pips to go. A little too premature at this time for me to take this trade. If I would have taken, I would have preferred taking it from up here all the way down here. But here, of course, it never made it all the way back, and it's going to continue to come down. And it just may come all the way down to 178.83. But at this point, when you're late, you're late. And I don't like to push or force a trade. That's not what we do. However, the importance of these levels is something that I've been trying to get across to you guys. And the reason why is because whenever you see these power dots come out, what they're telling you is that there's momentum and volume buildup coming in. Now, we have probably one of the best, if not the only, real volume indicator out there in the industry for the retail trader. I don't think anyone else has anything quite like what we have. Now, its importance is very important. Why? Because it tells you the story of volume, of what's actually happening. So in this case, you can see that the volume here was 36 million long, 32 million short. So there was about 4 million, it says 5.2 million to the upside, but it was a short candle. This next one, 18 million long, 30 million short, 12 million on the negative, and it did come down, not a big move. This next one, 24 million long, 18 million short. As you can see, nothing. It basically held. Then the next one came in, and that was 24 million long, 12 million short, 12 million long. You know, it moved, not significantly. Then this one was 6.7 million long, 25 million short, 18 million short, and look, it was a long candle. It wasn't short. This one, 22 million long, 24 million short, really almost 2 million difference. This one did come down, but nothing. So what we're seeing here in this level right here is we're seeing the actual volume and momentum buildup that's coming in. Now, one of the most important things that traders look for, which is what they miss the most, is when exactly should they be paying attention to the trade? When does it really matter? What we've done with these power dots is that the algorithm has identified exactly the levels where they repeat the same level of momentum and volume buildup before actually making the move. Now, so what does that mean to you? That means that 3 times, we'll circle these so that you can see, because 3 times what they did, let me make this a little wider. 3 times what they did is that they identified for you what you should have been paying attention to all this time. They were basically telling you that they were going to repeat the same level over and over again for you. And all you had to do was just connect the dots. So if you would have basically just been simplistic about it and just thrown a line from here to here, let's say that as soon as it began, and you can always change the color, you know. I like to use colors that stand out a little bit more for a visual. So if you would have used this, it would have literally given you the roadmap. Not only the roadmap of the level that they were not going to breach, but it gave you the roadmap of their volume and momentum right before they were actually going to drive this thing to the moon, 100 pips. Now, I saw this trade take place, and I saw it take place for 2 reasons. Number one, they were at a previous level where they had already come down and breached on Friday's close. When it opened, it never went above it. It came right back down. And so I took this trade. Like I said, it was very, very similar trade to the pound dollar. And then it really just came down 45 pips. So you only walk away with 20 pips. It's not bad. But this was the main course of the night. This was where they served the trade on a silver platter because it repeated itself. So if you see this repeat itself 3 times, then you're going to see and understand that what they're doing is that basically they're identifying, number one, the level that will not be breached, and number two, the momentum and volume buildup that's starting to come in before they drive the price in a certain direction, which is to your benefit. So these levels that we've done here, if we go back in history, you'll see that these levels basically repeat themselves. Why? Because every time that there was a power dot buildup, I would basically throw the line. And I would use actually the 30-minute. Now again, these are not pivots, so I don't want you to think of them as pivots, because they're not. In reality, what they are is that they're identifying levels that the bank's algorithms are tightly closely paying attention to. Do they repeat themselves? Yes, but not every day. You'll come to find that whenever they do, it'll be when, number one, no one's paying attention. Why? Because it takes too much for the human mind to actually calculate the level of information that they're calculating. It's practically impossible. However, a program can recalculate over and over and over. And I use the 10 and 15 minute to identify these levels of volume and momentum buildup. Why? Because that's the frequency that they're trading on. And so if it's coming out at those levels, then I don't need to be paying attention to anything else. If I went to the smaller minutes, like I told you, look at this, it's still coming down, and it may come down right to 179.03, which is this level. But it never breached this level. So as soon as it hit this level and never breached it below, since this level was identified very strongly also in the 360 minute, and I went all the way to that level or to that time frame. The minute I saw, then I knew that it was a very strong one, so I drew a solid line. Versus this one, which is not a solid line, it's more of a what do you call it, like a dot or a dash line. But again, it identified, as soon as it came down, it identified that it was going to go back up. Why? Because number one, it was too far. The distance from here to here is huge. I'll show you. Normally, whenever you see such a thing happen, I'm talking about 21 pip difference. Now from here to here, normally what I like to see is a difference of approximately 10 pips or more. This is 14 pips from here to here. This would probably be about close to 10, 8 pips. See, look at that, hit it right on the money. If it bounces right back up from here, then it'll come back and hit the trend stop again right here. But it doesn't matter, because at the end of the day, it identified the trade that was going to go long, which it did, and now of course it came down short. But they never broke above this level, which was identified previously by these power dots. So this is really the roadmap that you need to understand is happening, because if you're able to understand this specific part of the technology that we've designed, then you'll understand that it is cutting edge. That not only have we been able to quantify the momentum and volume buildup before it actually takes place at a certain price point, but we've also provided you with a volume indicator that tells you when they're doing it. Now, if you notice, there's not really a whole lot of volume when they're doing this. Very deceivious, very deceitful when, if you compare it to another volume indicator, because if you're comparing this, and let's do that, let's put on another indicator here just so that we can see exactly why this has been taking place. Because bottom line is, if you depended on the regular volume indicators out there, then you would literally not be able to take these trades, because you'd never understand why they're doing that. Without our volume indicator, number one, you don't know with this volume indicator what the total volume is. per bar because you can't. It won't let you see that. With mine you can, and you can see it in the live edge of the market, how many bullish orders they're pushing through versus bearish orders, and then it gives you the net. That's pretty phenomenal on the live edge. This one doesn't do that. And because it doesn't do that, it's basically lagging, bottom line. It just gives you a total. But a total doesn't really tell you whether it's really bullish or bearish. Ours is telling you with precision whether it's a bullish or bearish trade at the moment. However, here, with this type of volume, you would never understand, you'd never be in the trade. You would actually show fear of taking the trade, even though this indicator would come in, because you'd be saying, well, there's no volume here. Right, there isn't. So what this indicator does is that it takes away the fear, because it gives you that level of confidence that, number one, they're starting to build up volume and momentum, and that they're not going to breach this level. And even though there's no volume here, they're slowly going to set it up, and before you know it, then they're going to really kick it in and drive it. But many people would say, well, as soon as it comes back, it'll come right back down, because they came down to test, the high of the day, which in this case is the open of the day, and then come right back down, which is what they're trying to lead you to believe. What I'm trying to lead you to understand is that that isn't the case. The way their algorithms and the way their traders are using this is they're using it in a very deceitful manner that we've been able to key in to identify when they're starting to build up their volume and momentum right before they drive the market at a certain price point that historically they've done so. But when it repeats itself, in this case 3 times, you know that you have a trade. There is no doubt in your mind that you need to fear what is going to happen, because it's going to happen regardless. And as you see it over and over, you'll start to discover that. Now, this indicator is here for one purpose, and that purpose is to basically help you understand when they're taking out of balance a specific currency against its counter currency. Now, if I waited for this, I would have not really taken the trade. Why? Because I would have waited even more. Why? Because I would have waited for more angle and separation between both currencies to say, okay, it's safe to take this trade. Where here, this is really giving you the inside trade in advance, prior to it happening. The importance of these power dots is better than you can possibly imagine, because even if you added moving averages to this, let me tell you something, they would line up practically perfectly. And let's see if we can add a few. When in Rome, try and accommodate, and this would be an EMA there. And we're going to use a few of these. So I like using the 800. I like using the 200, and I like using the 50. Those are really my favorite ones. So we'll load this up. We'll put on the EMAs for you to see how they set up and how they look. I think it's important. Look at this. This moving average was all the way over here. This is a 15 minutes, so we can't really rely on this one. Let's add another one. Indicators. EMA. And we will put 200 on this one. We will change the color. And we will use white for linen. And then we'll use a 50. These are really the 3 favorite ones that everyone uses. Okay, Now right here it did line up with the 200. Pretty much right on the money. So let's see where the 50 ends up. And I'm not telling you not to use moving averages. Believe me, I use moving averages because for me it's just one more level of confirmation. I like to be right. I don't like to be wrong. In actuality, it makes perfect sense for me to be right. Because at the end of the day, it just does one thing and it does it very well. It gives me that level of confidence that I'm looking for, which many times we all miss because fear and doubt kill the trade. Bottom line is that fear and doubt kill the trade. Let's see if it comes up. Let's give it a second. Okay, so where is the 50? Oh, forgive me. Okay, so the 50 is right here. Now, if you would have seen this trade just based on the moving averages, just on this, in the 15-minute, normally people will take a look at it on the 60-minute. So let's look on the 60-minute and see where everything lines up. Because that's usually where everyone, real traders actually look at it. So we're looking at the 800, which is all the way up here. We're looking at the 50, and we're looking at the 200. Here, for instance, it bounced right off of the 50. It was always trading above it, never below it, but it was too close to the 800. So I guess many of you would have normally could have taken this trade, but as soon as it broke the 800, you would have said, whoa, wait a minute, but look how it lined up with this level. So if it just went from here to here, you were talking about close to, I'd like to say, 40, 50 pips. You would have missed this level up here. Now, I can't tell you where to take profit. That's completely up to you. Bottom line is that whatever you're comfortable with is good. For me, I like to be conservative, and I don't like to be at risk too much or too long. But I also like to trade when I'm awake. And if I'm not awake, then I can't trade. Bottom line is, that's just, psychologically, you just cannot trade without it, without being completely awake. So here, for instance, when you see these moving averages, yes, it made sense here, but we identified it right here. We were not waiting for them to come down and say, hey, we're starting to build up volume. No. We start looking at these trades, and you can see here on the 30-minute how it formed here on the 800, right on the 800 moving average. And the difference from here to here was huge. We said it was close to, 27 pips. So if the difference from here to here is huge, then basically we know that this is going to go long. So if this is a 30-minute and it lines up on the 800, lines up pretty well right there, then the next level is that they're going to bounce. But they're going to go right through the 50, which in actuality they did. So moving averages are great if you know how to use them properly. I like to use them to just identify and line up with my levels, because when they line up with my levels, then I know for a fact that I have something that no one out there has. Certainty. I'm looking for certainty. That is my main goal. Now this level broke here. It should come all the way down to 178.82. So from 179.30 to 178.82, that's a pretty decent trade. If it goes below this moving average, it'll come all the way down. But like I said, we were late, and I wasn't taking a trade just for kicks. So here, for instance, on the 15-minute, as soon as I see that this level is repeated 3 times, I know now more than ever that there's a powerful trade setting up, and that I have first-hand information before anyone else. That is the secret to our success. That's the secret to our technology, because no one out there is identifying when there is going to be volume and momentum buildup and when you should actually be paying attention to the trade. Bottom line is that every time that we try and look to see where the trade is, we're looking to see if it's trading above a certain moving average. If it trades above it, I'm going to take that trade. Well, if this comes up and this is happening right here and it's trading below, I don't care if it's trading below because I know that it's going to break above it. And it's going to scream to the moon sooner or later. Why? Because they never challenged it and they didn't do it 3 times. So this is a great example right here of a trade. This is one of those trades which I probably consider, because I've seen it so many times and I've seen it happen so many times, is probably the one that you would by all means say it's a winner of all winners. There is risk. The only risk is how many pips are you going to take out of this trade? That's the risk, because you may not get the whole thing. And if you know with practical certainty that their algorithm is not going to breach this level, but is actually going to test it, just come close to it, and then bounce from it, then you know you're good. Now, I would have preferred if it would have done it from here, the way I see this one here. And we'll go back. See how this level appeared right below this previous level? This, for me, is a much more solid trade than this one. However, why? Not because of the amount of power dots that came out. It's because it was at a very close distance from a previous bearish level, that if it broke below it, it would come down. But because it didn't break below it, then it basically made a move up. But it was closer to a previous level that was hit, which was much stronger than this one, because this one was not this close. It was right smack in the middle. But the fact that it repeated itself 3 times basically told me that it was going to be a continuation move to the upside one more time, and they did. They came up and they challenged it, but they never breached this level, which was previously, because if they breached this level, then they really have to go long even more, and they didn't. They came right back down and bounced. So this was a great example. I think that if you understand the theory behind what we've done, you'll not really pay attention to the lines. You'll pay attention to these levels. The moving averages are there to help you, and they're really for your benefit. If you know how to use them, they will make sense. And if they make sense, then bottom line is it's just one more level of confirmation. That's pretty much it. It's just one more level of confirmation. And for me, that's all I need. I just need to be sure. I'm very particular about being very, very sure about a trade. And if I'm not sure, I'm not happy with it. Now this one was the pound yen, and the previous one we were looking at was the pound CAD. The pound yen did the same thing. I sold it up here. Why? Because they came up, tested this level, but more importantly, I was able to identify that any time that they came to this level, since it was right below this one, came down. So I waited for this to come down. If it didn't breach above it, it was going to come down. So as soon as it came down, I took this trade from here to here. Not a big trade. Could have waited. Could have picked up, 45 pips again. But then this came up, and this came up right below it. So as you can see, they went up, down, but never broke below it until finally it really came down. Now, when it came down to this level, again, here, what was the difference? There were no dots, no power dots. So I would have been somewhat skeptical of taking this trade. I would have taken it just based off the fact that this level was never breached, and it was a very important level previously. So if they didn't breach it, then they would go long. Then you're taking on a little bit more risk, I think. I don't like to do that. Now, because this level is identified right here again, as you can see, 185.90, within the next day or two, they're going to come and hit this level. So make a note of 185.89 because this level is going to be hit within the next 2 days, and they're going to use it as a support level or as a resistance level. When they trade below it, they're going to come down from it. When they trade above it, they're going to scream to the upside even more. So in advance, I've also noticed that anytime that they do come up like this, see for instance this level right here. See right here? Look at how every time they've hit this level, they've traded either below it. In this case, they went up, but then they came right back down, went below it. Here, as soon as they traded above it, they basically went up. The same thing's going to happen here. It's, for me, like I said, if it's because this was already trending, the trend stop was going up and it was driving price action up. As soon as this came up, it just told me, as soon as this dot came up, it just told me that this was going to be a continuation move. It wasn't going to be like this trade where basically price action is trading below it and it was going to come down. In this case, it came back up, but then it came right back down. Now, I got into it here, but as soon as I saw that it broke this level, then I knew it was going to come down even further, but it didn't matter because I wanted to get out right here. So the dots are very significant because they tell you the story that no one out there is telling you, and that is when the smart money is coming in. What's the smart money? The algos, the algorithms that they've designed to drive price action. And if you can understand and appreciate that, then you're going to be able to take your trading to the next level. That is when it really matters. So we've taken a look at pretty good examples. Let's take a look at this one. This is the Euro New Zealand. Now, why would I not have taken this trade? You know, it was a very strong move to the downside, even when it came here. It's very simple. The reason why I would not have taken this trade is because it didn't give me the volume momentum identification that I was looking for. Great trade, but I like to trade with certainty, not with uncertainty. So if I would have based my decision off the 15-minute, it would not have been one. It would not have been a good decision to base my decision to take a trade because I'm looking for certainty. And if I cannot have 99% certainty, then I'm not interested in taking a trade. Let's see what happens with a 10-minute. As you can see here, same thing. Yes, they came up, never traded above this level. And as soon as they came down from this one, it was open game. When this came down, it was pretty much going to be a continuation move. Why? Because, number one, they were already trending below. Price action was below the trend stop. So this was just going to tell you that it was going to be a level where they were just going to breach. Now, same thing here. As you can see, the trend stops, because they were all, price action was trading above the trend stops. As soon as this came up, it was pretty much identifying that it was going to break right through it. Now, it came back down at the end of the day, but then look at when it opened. I mean, it screamed to the upside. It opened in such a nasty way from the previous close that there was a difference of 45 pips on the open. So if you would have been short on Friday, you would have really been in bad shape because it screamed. There was such a gap. It was ridiculous. And they came back and they closed the gap, as you can see. But not a trade that I would have been really attracted to. Even though I plotted the levels, these same power dots, where they plotted before, I plotted them, and this was a very important level because it was not just on the 30-minute, but on the 360, on the 180. So this was a solid line. This is not a solid line. It's more of dots. So it only applied it on the 30-minute. Same with this one. As you can see, as soon as it broke, it screamed. But as soon as it traded below, boom, came right back down. So historically, I've seen that. But any time that I see this happening, that's when I know that I need to pay attention. Now, granted, if I understand the importance of these power dots as a trend is already taking place, it's just telling me that it's going to continue to come down and really scream to the floor. That's basically what it's telling me. So if you can differentiate both, then you know that you've got a trade. The Euro Aussie, another one. When I look at it, I would have taken this trade at the open. Why? Because at the open, it started to trend to the upside. It opened very high. I mean, we're talking about probably a 30, 40 pip difference. They never really came down to challenge the trend stop and just continued to move to the upside. But these dots right here told me, these power dots here told me there was going to be momentum build up to the upside. Even at the close of Friday, it identified it. And whenever you see this at the close of a day during the week, regular sessions, guess what? They're going to literally scream to the upside. So based on that information, yeah, it makes perfect sense. Let's take a look at the pound yen real quickly, because look, it came down below this level the way we had spoken, and now it's at 186, 185, 84, which is where we were looking at on the 15-minute, if I'm not mistaken. That's a pretty decent trade, but we were late in the game. So yeah, the Euro Aussie, great trade to take here, great identifier, but not really a huge trade. And there was no level up here identifying that it would trade below. So this was not a good candidate to be looking at. The euro dollar. What a doozy. This one at the open just broke above, and then came right back down. Then again, as soon as the trend stops, started to go up, and this started, just told you it was going to go long. When it came down, same thing. Look, it broke right below it. This was not a real safe trade. I would not have taken this trade. I would have, if price action would have come here and then bounced off of this level, yes, I would have probably taken that long. But because it was too much of a wild card, not the greatest candidate for me to be looking at all. Even though it did move, sometimes, you have to stay away from those. Now this one, when this came out, this was a good identifier. Why? Because it had previously come down, bounced right back up, hit it, but price action was below it. Same with here. Price action was above this. It wasn't below it, or it wasn't coming down. So when you see this, then you know that you've got a trade. This was a trade to the upside. Great trade to the upside. When it came down and came right here to identify this level, is basically the same level up here. But they hit it, came right back down. In this case, it just came screaming down even further. And by trading below this line, that means that it's going to go should come all the way down here to 113.39, the US CAD. That's the level that it should come down to. But this right here was the identifier for me. Let me change the crosshair. We will put so that we don't forget it. As soon as price action started to trade below the trend stop and it came and hit this, another good example of it coming down. Like I said, and this happened during the European session. So if you see that, then basically you know that you have a trade. Now if you're trading the European session, then great. Great time to really be looking at this. But again, what we're seeing is that we're able to identify, and you can see here on the 10-minute, they never challenged it. They were always trading below it. Great example. And then boom, just came all the way down. This was a trade that I would have been looking for. This trade out the gate was a great trade on the US CAD to the upside. Why? Because of the distance. At the as soon as it opened, you're talking about more than 10 pip distance. Trend stops going to the upside, boom, Nothing really more to look at. Would I have missed this whole section of the trade here before it came down? Yes. Again, you don't know if it's going to come right back down and bounce up. As soon as this came up, this told you continuation move to the downside, and that's what you're looking for. You're looking for certainty. You're not looking for uncertainty. Uncertainty with risk, because there's always risk. This trade, for instance, as soon as this came in, or this showed up, it was pretty much going to come right back down and retest. When this came up and you saw price action that was going up, then basically you knew that this was not going to come down. It was actually going to go up. What's the difference between this and this? Price action and the trend stops are trading below this. Here, they were never really trading below this. They were going right at it, like a train. So as soon as that happened, they were going to come right back up and retest. This right here was a great example of the trade that you should have been paying attention for, because it was right in front of you at the open. And sometimes, like I said, we just need to really pay attention to what the technology is telling us. And if we pay attention and follow directions, which as traders we don't like to follow directions, then you would have taken this trade to the downside, and this trade would have yielded you approximately, well, at the open, it opened up with a gap, of course, but it would have yielded you close to 60 pips. That's not bad. That's pretty good. A 60 pip drop from here to here, that means that this is a 100 pip move to the upside. Would I have taken this trade when it was here? Not really. Why? Because I couldn't identify a previous level there. So if I couldn't identify a previous level, then I'm not taking it. But as soon as it ran right through this and this started to form, that means there was momentum and volume buildup coming in. Look at this. This is 10 minutes. This is giving you a 30-minute window before they actually explode. That's pretty big. This, of course, is giving you a 1 hour window, but of course it's at the end of the day. But bottom line is they were going to come down, and they did. So if you can differentiate these power dots when they're being used as a support and resistance level versus when they're being used to identify that they're going to go right through them, then at that point you know that you're solid. Let's see where this thing came down, because it came down pretty sharply. It's still coming down. Look at that. It should come down to 185.71 because previous level, and normally they hit right there. And if it breaks that level, then it'll come down even further. But we missed that one. Shame. Now, the U.S. yen. This was an interesting one. Couldn't really figure this one out. I looked at it, and out the open I knew that it was going to go long because, number one, as you can see here, the power dots came up here, went long, and then they came up another level higher. So if I see that they plotted another level higher, then I knew that it was going to go long. But I wasn't too comfortable with this trade, so I didn't really take it at the open. As it came down, I would not have been able to really take this trade to the downside here. I would have been paying attention more here. As you can see here, this was a clear window telling you. And again, let's circle that because it makes sense. If you can understand the science that we've created for you, you will be able to really pinpoint these trades, and you will be able to take advantage of the information that is being provided by these silly banks that now cannot hide their volume from you any further. Look at how this thing's going down, and it's going to come right down to 117.65. That's a pretty big drop. So it went from 118.40 to 117.65. Wow, almost an 80 pip move is what you're expecting on this one. Again, this one we were late coming to look at it. Nothing really excuse me, extravagant of what happened up here, I would have never taken a trade up here because I never had an identifier telling me, hey, pay attention. And I'm going off of the 10 and 15 minute to look for the entries. I mean, seriously, you got to really appreciate that, this is quite a bit of notice. And here you had literally 60 minutes, a whole hour, to make your decision to go short. What was the difference here? Number one, the trend stops and price action were trading below when this started to plot. That's it. That's the science. If you can understand that, then this software is for you. Why? Because at that point, you'll start to pay attention to the volume. And if you notice, every time that they do this, the volume is very, very low because they don't want you to get in on the trade. They want you to stay out. Look at this. Look at the volume here. When it starts to plot, look how low it is. I mean, most people would not even touch this with a 10-foot pole, where we're telling you, jump in, take the trade. Take the trade because it's going to play out and you're going to make pips. What was this move? Let's measure this move. And that's the difference. Nothing more, nothing less. This would have been 50 pips for you. 50 pips. Are there any questions? This would be a good moment because we're going to be ending soon. Well, in the meantime, I'm going to put my email for you guys to send me any questions. We actually moved the website to a different host this holiday because we were having problems with our emails. So I do apologize for that. If I didn't get your emails before, that problem should be resolved after today. So I put my emails there for you. If you have any questions, feel free, send me an email. More than happy to respond back to you and get you set up. Bottom line is, if you understand the science that we've created, that it is cutting edge, you will want to trade with this because you won't ever want to trade without it. We have tapped into how their algorithms are reacting and driving price action and momentum buildup and telling you when you need to look at the trade. That's it. One of the things that we're devising right now is alerts. As soon as these dots start to plot, we're going to have alerts set up so that it sends you an email or makes a sound on your computer, of course, to say, pay attention, their algorithms are active and they're going to start to drive price action and momentum into the market. And that's really what it comes down to. But if you don't understand how to map out what they've previously done, you won't have success because you won't be able to understand why they're doing it. And granted, the volume is important. Make no mistake, the volume is extremely important to understand, how many millions or billions they drove into it long versus how many billions they drove into it short. Bottom line is that that's what makes sense. That is what you need to be paying attention to. So if you're all good, I am for today. I want to thank you very much. I look forward to seeing you on Friday morning. For those of you that have already purchased the software, I'm going to be sending you an email today, this afternoon, and we're going to be starting training tomorrow afternoon at the open of the new day, which is about 5 Eastern. So I want to thank you very much. Have a great week. Hopefully you've been able to learn something new. and we will talk to you soon. Thank you very much. Bye-bye now. Thank you for coming to Phoenix Trading Strategies.